Welcome to the webinar on the state of billion-dollar unicorns, a topic I'm very excited to dig into with you today. My name is Alex Lee. I'm an editor at CB Insights, overseeing research on technology and VC trends. Now, before digging into unicorns, I want to give a quick intro to CBI and how we work with the world's leading companies. Our technology intelligence platform provides companies with comprehensive data, expert insights, and work management tools that enable them to discover, understand, and make smarter technology decisions. When it comes to these technologies, our approach to collecting both quantitative and qualitative data allows us to create differentiated value, especially when it comes to synthesis, analysis, and visualization. And now to dive into our webinar agenda. So today we're talking about unicorns. These are private companies valued at $1 billion or more. And really, unicorns are a phenomenon of the tech world. And in some ways, they're a good reflection of where the tech world or tech ecosystem is at a given time. So we'll dig into all of this and more. But broadly, we're going to talk about the current state of the unicorn club, as well as what's next heading into 2024. So to understand the state of unicorns today, we need to zoom out a little bit and look at the venture market broadly. So this chart is showing equity deals and funding to companies in the venture market over the past few years. And you can see here the boom in venture capital in 2021 and into early 2022, and then a pretty precipitous fall off starting around Q2 of 2022. As tech companies faced macroeconomic headwinds, rising interest rates affected how VCs were investing and the extent to which they were investing, and a number of other factors. So this has had a pretty monumental impact on the number of unicorns being born quarter over quarter. So this chart is showing you the total size of the unicorn club. So today it's over 1,200, but rewinding to Q1 2021, you start to see it really pick up pace, where more than 100 companies are hitting unicorn status each quarter through to early 2022, when that growth really starts to taper off and plateau. And then finally, it grinds to a halt. Just last quarter, there were only 12 new unicorns born, again, down from hundreds of just a couple of years ago. This has put us at an interesting point in time where the unicorn club, which has been progressively growing for nearly a decade, is for the first time on the verge of shrinking. So we will get more into what's fueling that potential decline a little bit later in the presentation. To start, we're going to talk about the 1,200 plus unicorns in the Unicorn Club today. Now, our amazing design team has put together an incredible market map with every single one of these unicorns. It's an impressive design feat. I encourage you to look at it. I'm not going to spend time going into it today, given its size, but you can get the full map and list at the link on this slide. Now, we have sorted every single one of these into the industry that they target. And so you can gather some information by looking across the distribution of industries. Namely, enterprise tech is a clear leader here. Nearly 1 in 3 unicorns are operating in enterprise tech. This category includes B2B horizontal technology solutions like HR tech, expense management, cybersecurity, and core AI systems. It's followed by financial services with 18% of unicorns, and consumer and retail with 17%. Now, sticking with this sort of industry-wide view, let's look at just the new unicorns born in the last year. When you shrink the scope of the analysis to just the last year, it's heavily weighted towards enterprise tech companies. 20 new unicorns in the past year, accounting for 34%, I'm sorry, of all of the new unicorns. Now, one technology in particular has really fueled this shift towards enterprise tech, and that one technology is generative AI. 1/3 of those enterprise tech unicorns have been Gen AI companies. Some of these you might recognize, companies like Cohere, AI21 Labs, and Adept. They've all reached billion-dollar valuations or higher in the last year. And the Gen AI factor really can't be ignored at this point. Gen AI companies are reaching unicorn status much faster than companies in other sectors. As you can see here, the average time to unicorn status for new Gen AI unicorns is roughly 4 years from when they were founded. That is about nearly half the amount of time it's taking for the entire unicorn club. So these companies are reaching unicorn status much faster. Their valuations are increasing at a faster rate. Just this past weekend, I wanted to share this case study. Mistral AI out of France hit a $2 billion valuation, which is nearly 8 times its seed valuation. Now, the remarkable thing here is that it just raised that seed round 6 months ago, and it was founded just in early 2023. This kind of remarkable trajectory to become a unicorn is exceptionally rare these days in the tech world. And we're really only seeing it with generative AI companies, where investors are really excited to be getting into these deals and are fueling valuations to climb through the roof. Now, zooming out to the full unicorn club, when we look at it under a geographic view, the United States dominates. More than half of unicorns are based in the US, and that's a relatively consistent share over the years. China comes in second, and India in third. Now, interestingly, China has produced fewer new unicorns than historically in the past year or two, while India is accounting for a greater share of new unicorns year over year. So, a country to watch. Now, across industries, valuations differ to some extent. The median valuation in fin services, for instance, as well as media and entertainment, is 1.8 billion, which is pushing it higher than we see across other industries, or the median, which is 1.6 billion. But of note across all of these industries is that valuations tend to fall for unicorns between 1 billion and 2 billion. So really the lower end of sort of the possible valuations. It's much rarer to see unicorns pushing, say, 10 billion, 20 billion valuations. Now, using CB Insight's headcount data, we can see that unicorns actually continue to hire employees almost across the board. Now, this is surprising given reports of mass layoffs around the tech sector. But if we look by industry, the median headcount has increased for almost every industry, except for insurance and media and entertainment. This partly is due to many of these companies raising a lot of funding in 2021 and early 2022. And so that capital is helping sustain some of their growth trajectory. However, the market shift and also investor demands for efficiency and cost cutting could turn some of those figures into the red. In the coming months, we may see unicorns continue to shrink their workforces. And finally, while looking at the current state of unicorns, let's dig into the top investors. There are thousands of investors with equity stakes in the current unicorn club, but some really stand out. Tiger Global and SoftBank, for instance, both have well over 100 unicorns in their portfolios. And these are non-traditional investors. meaning they're not the traditional type of VC that you see among Andreessen Horowitz, Excel, Sequoia, et cetera. And they really made a name for themselves in 2021, fueling the boom in late stage capital. This has, to some extent, had a ripple effect into today, where these investors have so many unicorns in their portfolios. But as these unicorns face pressure on their valuations, Tiger Global and SoftBank have both had to mark down their private portfolios pretty substantially to reflect a decrease in aggregate value. So to sum up, the Unicorn Club has grown tremendously over the past decade, helped by investors like you see in front of you, until the bubble essentially burst in 2022, and the growth of the Unicorn Club came to a screeching halt. And now, as I mentioned, it's on the precipice of starting to decline. So what's next for the world's 1,200 unicorns? I'm going to talk about some of the factors fueling that potential decline that we might see play out in 2024. So to start, more down rounds. Down rounds are where companies are raising fresh private capital at a valuation that is less than their previous round. So many of these companies raised during the boom times of 2021 and 2022 at very inflated valuations. It's pretty unlikely many of them will be able to command those valuations, let alone raise at a higher one, should they need to raise fresh capital. More dramatically, we're also going to see more shutdowns, more bankruptcies, et cetera, as companies run out of cash runway. Just in the past couple of months, we've seen a handful of unicorns like Convoy and Vive, as well as Olive in the healthcare sector, shut down. Now, on a potentially more positive note, a few other factors driving the decline, potential decline in the Unicorn Club is exit activity. So on the one hand, as valuations and prices come down, this creates an opportunity for tech buyers to snap up tech companies at cheaper prices. So we're already seeing this with tech unicorns buying up other unicorns as they look to consolidate market share or take out some of the competition. So for instance, on the left side, you see here Gorillas, a player in the ultra-fast delivery space, was acquired late last year by its rival Getir for 1.2 billion, which is just a bit over a third of its previous valuation of 3.1 billion. On the flip side, we are expecting to see more tech IPOs next year. The IPO market has been frozen solid for around 18 months, and many companies have been waiting for it to open up again. They've been primed to make their public debuts when the market conditions are ready. This is starting to creak open now. In September, just a few months ago, several former unicorns, Instacart and Klaviyo, went public. Arm also went public, as well as Birkenstock, and many investors were watching these IPOs to essentially serve as a litmus test of where the market is, and they were hoping for a positive result so that other companies could start to go public. These companies have performed decent, but not great in terms of their share price since going public. And so it wasn't really the outcome that a lot of investors were hoping for. And some analysts believe this has closed the IPO window a little bit for the coming weeks or months. However, there are many companies waiting in the wings to go public, and some won't have the luxury of waiting much longer. They may need access to capital sooner rather than later. Their employees and investors may be pushing for an exit. So we could see companies going public even if the market conditions aren't perfect. So in service of that, we recently dropped our 2024 tech IPO pipeline. This is a list of over 250 companies that we think could be weighing up going public in the next 12 to 18 months. A few of these have already started to make nods to doing so. For instance, Shein, based out of Singapore, the fast fashion giant, listed, or rather confidentially listed, in the US just a couple of weeks ago. So keep your eye on these companies. You can get the full list using the link on this slide. Now, all this to say, it's a somber environment for tech and for unicorns specifically, maybe a difficult environment in terms of access to capital and the requirements of success, or the measurement of success, is different now than it was a few years ago. The focus now is really efficiency, sustainable performance, and really gaining commercial traction as opposed to simply growing revenue, growing headcount. Now, all that being said, the companies, the unicorns with strong business models and strong commercial traction may come out of this down period even stronger than before. And those will be the companies to watch in the future. And that concludes the presentation for today, but there are plenty of resources I wanted to share with you so you can continue digging into this and keeping your eye on these companies. So there are several free research pieces that I've linked here, as well as several in-platform assets for CB Insights customers. And then finally, just wanted to thank you for being here and say that you should feel free to reach out to me directly or to us at CB Insights. There's my email right there. You can send me questions, feedback, thoughts, predictions for 2024. I would love to hear from you. Thank you so much.